The other piece of advice I'd have is don't get yourself in that situation, right? Which is, a real investment strategy, the kind of stuff that we do every day, is constantly trading. Not necessarily every day it's trading, but it trades frequently so that you don't get a buildup in just one part of your portfolio that's just massive over 10 years or 15 years or longer. That just becomes a taxable problem that is difficult to deal with, and really only taking the air out of the balloon slowly, if you've got the luxury of slowly, is the best way to do that.
What about when it comes to, like, you bought Tesla or you bought Apple at a very low price point, and the stock has shot up, and it's multiple $1 million of gains, and you're going, man, I'd love to sell this thing and diversify, take some gains, or real estate or a business, right? But you're stuck with huge capital gains taxes. What do you say to people who call you and be like, look, I got 10 million of Apple stock, David, that I bought 30 years ago, and my basis is $175,000. Like, what kind of conversation do you have with there?
So we have those discussions with clients, and usually it's a let the air out of the balloon slowly type of approach. It's all contingent upon people's objectives and where they are in life and their risk tolerance. All these other factors come into it. But broadly speaking, you got to let the air out of the bubble there, because you're under diversified. You're probably moving into a stage of life where you got a huge amount of gains there, and either you don't believe in that stock anymore, the conditions have changed, or you just need to start to take income and you need to diversify, different stage of life, these kind of things. These factors come in. But so let the air out of the balloon slowly. I think, and that means put it into things that are gonna be more tax efficient, like I was talking about earlier, right? That are going to trade in a more tax efficient way with less taxable exposure. The other piece of advice I'd have is don't get yourself in that situation, right? Which is, a real investment strategy, the kind of stuff that we do every day, is constantly trading. Not necessarily every day it's trading, but it trades frequently so that you don't get a buildup in just one part of your portfolio that's just massive over 10 years or 15 years or longer. That just becomes a taxable problem that is difficult to deal with, and really only taking the air out of the balloon slowly, if you've got the luxury of slowly, is the best way to do that. I mean, there are other advice that a tax accountant would give you, but from the investment management perspective, it's don't get yourself into these situations. Invest in a tax smart, we call it tax intelligent way, that prevents these gains from building up, and adjusts portfolios at a regular interval. And there's really no reason to hold anything for a terribly long period of time anyway, given that opportunities are, shifting over the business cycle, anyway. So there's not much of a loss if you know what you're doing to your portfolio. In fact, there's huge gains to kind of evolving your portfolio over the business cycle anyway. So try not to get into that. The one way to not get into that is to work with an investment advisor or professional managers like us, who can help you kind of avoid just buy and hold forever kind of strategies. And then the other is, when it is time to take the air out of the balloon, don't get in the same situation again and just move it into another thing that you're going to hold for 10 years.
Yeah, I couldn't agree with you more. And by the way, what if there's a way where you didn't have to let the air out of the balloon, but you could still get that liquidity, that diversification, and all of the things you're talking about? We believe we have that way. It's called a deferred sales trust. It works for the sale of any asset of any kind. And you can sell that public or private stock, defer that capital gains taxes. On the public side of things, we actually can eliminate that estate tax as well, which is a big, big thing where I feel like a lot of people, we tend to maybe forget a little bit if you're not really focused on it, where the estate tax is above and beyond anything. Basically 10 million married as of 2026 is going to be subject to that 40% death tax. And so you can sell using what's called a DST plus or DST 2.0, that public stock. You can eliminate that estate tax, defer that capital gains tax. But the best part we think about it is you can start to invest into these types of strategies where you're diversified. And it's within professional investment advisors. If you want to learn more about that, you can go to capitalgainstaxsolutions.com, everybody, capitalgainstaxsolutions.com. And also we got our book, Building a Capital Gains Tax Exit Plan, where we talk about this. In fact, David, we had Kevin Harrington from Shark Tank on my podcast, and he's in the book now, I think partly because of the question I asked him. And he asked me, he said, Brett, you're telling me he bought into a stock, a Celsius. He sat on the board for like 26 cents a share, this energy drink, and it went to $23 or $24 a share And he goes, "You telling me that there's a way you can defer capital gains tax on the sale of public stock?" And the answer is yes. You can check out the book, Building a Capital Gains Tax Exit Plan, or go to capitalgainstaxsolutions.com.